Hello, and welcome to the fourth episode of the Economics for the Rest of Us podcast. This week, we're going to talk about something a little bit on the abstract side, and that is the macroeconomy. We're going to look at our economy from kind of the outside. We're going to take the big picture approach. So this week what I want to do is take a look at the overall money system and kind of show some of its basic dynamics, just so we can get a handle on how our economy functions at the largest level, so then we can hopefully understand a little bit better how it functions on more individual levels. We'll have a little better perspective and a little different reference points than most people have available to them. So the first thing that we want to understand is that our monetary system is a cycle. So money moves from one part of the economy to another and then back to the first part and on and on. For instance, let's think about wages and spending. If we think about the whole economy and all of the households, all of the consumers, all of the citizens in our U.S. economy, the money that they have to spend every month on, their housing and food and all the necessities of life comes from their income, and that income comes from businesses, and where the businesses get the money to pay those wages and pay that income to households is through sales that they make to those same households. Right, so this cycle continues. Everything can hum along, all hunky-dory, just so long as everybody is always spending all of the money that they're earning, either in income, if they're a household, or in revenue, if they're a business. But problems happen when there are leaks out of this cycle. So in the same way that if your car engine has an oil leak, that's going to cause problems unless you do something to deal with it. We have various leaks in our economy where currency, as it were, leaks out of our economy or pools up in different places, and that can cause friction. It can make things difficult because there's not enough currency in circulation to allow the economy to function properly. There are a couple of major leaks that the U.S. economy has. If workers decide that they want to save some of their income, then that decreases the amount of spending in the economy. That decreased spending then necessitates a decrease in spending by businesses on wages. So we end up with this sort of downward spiral. Economists have a word for this. They call it, or a term for this, they call it the Paradox of Thrift. It's a paradox because being thrifty, as all good Boy Scouts like myself have been trained to do, to spend less than you earn and put money away, that's a good idea for anybody on an individual basis. But if everybody tries to do that, if everybody spends less than they make, then that leads to decreased sales and therefore decreased wages, which is requires some kind of infusion of additional money back into the system to get things back to where they were. So either that money that had been saved, that had been taken out of the system, whether by businesses or by households, has to get put back in. So people have to either spend down their savings, or businesses have to spend down their savings, or there has to be some kind of loan that goes on. People have to borrow money to maintain their spending levels. That's something we saw a lot of in the late 90s and 2000s up through 2008 with the financial collapse. We saw a lot of people maintaining their spending or increasing their spending even through cheap finance, through easy credit. One of the other major leaks in the economy is our trade deficit. So we import way more things from overseas than we sell to people overseas. The result of this is that there is a constant flow of U.S. dollars going to places like China and Japan and building up there in those foreign company bank accounts. If we didn't have net imports and positive savings, we would, if we still had a growing population, then just that fact would lead to there being a smaller and smaller average amount of currency available, which again would lead to problems in the economy. So we have a growing population, we have net imports, and we have people saving. All of this tends to lead to shortages of currency in the economy if left unaddressed. So how does the government do that currently? Currently, the mechanism is through the Federal Reserve. When they want to increase the amount of money in the economy, they buy financial assets from the banks, usually treasury notes or treasury bills. Sometimes, like in 2008, they'll also buy other types of financial assets from banks if there's nothing else available, like mortgage-backed securities, for instance. The idea is that the Federal Reserve will exchange with the bank some of their financial assets for increased currency. The banks, since they make money by lending out money, will then, it's expected, take that new currency, go out, lend it into the marketplace, thereby injecting further currency into the overall economy. Now, the problem with this should be obvious, which is that anytime you take a loan from the bank to do anything, you are expected to pay the money back to the bank along with interest. What this has tended to lead to is a buildup of wealth, of financial resources in the financial industry. Not because they're especially productive, not because we couldn't live without them, but rather because they have the first dibs, as it were, on all the new currency that comes into the economy. They get the first crack at it. What are called the primary dealer banks, that is the large Wall Street and international financial firms who are allowed to deal directly with the Treasury and the Federal Reserve. These banks are the only people who get access, have access to newly created currency without it coming with a debt attached. Because when they get the currency from the Federal Reserve in the form of reserves in their Federal Reserve account, we'll talk about that a little bit more later, but when the banks get the new currency from the Federal Reserve in exchange for their financial assets, they're just selling something. There's no debt on their part attached to it, on the part of the banks. Now, when they go and lend it to us, of course, now that's coming with, that access to that new currency is coming with a debt attached to it. So when you hear people talk about debt-free money, this is what they are talking about. They're upset that everybody except for the banksters only has access to new currency with a debt attached from a bank. Now, the Federal Reserve is not the only way that new currency could be added to our economy. This is the way it's done now because of legislation that's been passed that set up this system. However, it's not in the Constitution. Those laws could be easily adjusted or changed, completely rewritten or overturned if the political will existed to do that. There are other ways that the federal government could do the same thing that the Federal Reserve attempts to do, which is to maintain an adequate level of currency in the economy. One of these ways would be for the federal government to fund a job guarantee. So we could take our employment offices, and instead of having them be places where you go to, when you're unemployed, to fill out applications and hope to get an interview and then hope to get hired at whatever jobs are available there, these would instead be employment offices where you came and were hired to do some work for the community that your community, your city, your town had decided needed to be done, and the federal government would fund it, could fund it. There has been direct funding of federal programs in the past. There's no reason why we couldn't do it again. There are a number of ways technically that this could work out. One of them that's been brought up by a number of people, Paul Krugman, probably the most notable, most popular mainstream personality, economic personality among them, to discuss this is the concept of the $1 trillion coin. The Constitution does give the Treasury specifically the right to coin money, and so there is nothing that would stop the Treasury from having minted a coin with a face value of $1 trillion, say, and depositing that in their Federal Reserve account, and that would provide adequate funds to, well, fund just about anything. And of course, if we spent all that down, they could do the same thing again. The problem is not one of technical unfeasibility. The problem is really one of political will. So let's talk a little bit more about how a job guarantee program could work. I imagine it like this. There is a system called participatory budgeting in which local governments put aside a certain amount of their budget to be spent, to be directed by the local community. So everybody in the neighborhood, in the town, gets together at the high school gymnasium. People offer suggestions, have project proposals. The community votes on which ones they want to see done the most and allocate the public money to those projects as they see fit democratically. We could do the same thing very easily for a job guarantee program. Municipalities and counties could be directed to coordinate town hall type meetings where people would make proposals for work that needs to be done in their community. This could be anything from infrastructure development to tutoring children at the local schools. It could be taking care of elderly folks who need a little help around the house, making sure that they can stay in their homes as long as possible and don't need to go to a nursing home unless it's absolutely necessary. Things like that. There's really no limit to the types of work that could be done, that we could have people do, that would be valuable for everybody. The only problem that comes up is funding it. And of course, there is this idea that the federal government needs to fund their spending through taxes or through borrowing, but this is a fallacy. The federal government, as a point of fact, does not need to fund its spending through taxes or borrowing, and the proof of this, we just have to look at 2008, when the Federal Reserve purchased a couple $1 trillion worth of financial assets from banks with money that they created out of thin air through keystrokes. They just increased the balance in the bank's accounts and took those financial assets off their books and put them on the Federal Reserve books, and that was that. They didn't have to tax anybody to get the money to purchase those financial assets. They didn't have to borrow the money from anybody to purchase those financial assets. We could fund a job guarantee program in exactly the same way. Now, the supposed problem that's always brought up by people who are frightened of this sort of thinking is the problem of inflation. Just like we saw in the last episode on Nehru, that inflation is often used as a boogeyman, as it were, to a scare tactic to justify pursuing policies that maintain an unnecessarily high unemployment rate. It's the same thing with direct funding of federal spending. People say, well, what will happen is you'll end up with too much money in the economy. That will lead to price inflation. Prices will go up since there'll be more money chasing the same amount of goods in the economy. And that will end up being worse for everybody than the problem that you were trying to solve initially. Now, it is a possibility that, you could dump too much money into the economy and it could lead to inflation. But there's no reason why that would be a necessary outcome. There are many ways to take money back out of the economy, and of course one of them is taxation. So if we think there's too much money in the economy, you can always levy a tax to take some of it back out. But it's far easier and take that money back out of the economy through taxing than it is to try to put it into the economy through lending, which is what we do now. So let's take a look at government spending a little bit more. Now this is the difference, one of the differences between macroeconomics and microeconomics. In microeconomics, every economic actor, every economic agent, whether that be an individual or a business, has to first earn money or get money somehow, maybe earning it or borrowing it, before they can spend it. It's a logical necessity. Nobody seems to question that. However, on the macro level, that can't be true for everybody. Why not? Well, because if it was true for everybody, where would the money come from to begin with? If everybody had to first earn US dollars before they could spend them, and then how would they have gotten there to start out with? So somebody, as it were, some entity has to set the whole system going and provide the currency in the first place. That's what governments do nowadays. Used to be temples, now it's governments. And how do they get that money out into the economy to begin with? Well, they spend it. They spend the money into existence. By necessity, the government, the U.S. government, whoever the currency issuer is, must first spend their currency before they can tax it back, before anything else can happen. There must be spending. So the line that we hear continually from politicians and from economists who have their heads entirely too far up their asses is that the government is like a household or like a business, and the government needs to, quote, balance its checkbook. The government needs to ideally take in more money than it puts out in spending. Now, it should be obvious at this point why that's a bad idea. The government is the only entity that does not face a financial constraint, that can, and in fact must, spend more than it takes in if the whole system is to continue functioning. Now, if the government is taxing more than it's spending, that is, if it's running a budget surplus, that means it is taking money out of the economy. Means the federal government is itself becoming one more drain on the currency in our domestic economy, along with our net imports, our trade deficit, our savings, especially by the uber wealthy who can save a whole bunch. We then also get savings by the government. It's just the paradox of thrift multiplied, and stems from a total misunderstanding of the basic dynamics of a national economy. So what happened when we ran a budget surplus? There have been times, a few brief times in the history of our country, when we've run a budget surplus. The government has succeeded in doing what politicians always claim they want to do, and they've taxed more than they have spent. Bill Clinton did this. And most people see this as a good thing, something that can be pointed to as, he may have had a lot of problems, but at least he had a budget surplus. Well, what was the result of Clinton's budget surplus? The result was that there was less currency in the economy available to be spent and to be use for wages. In order to maintain spending, something had to give. And so what happened was we saw a dramatic increase in household debt. So people continued to spend what they had been spending before, but now they were having to go into debt to do that. And of course, that can only maintain itself so long before it collapses. And that's what we saw really in 2008, was the end result of that budget surplus. Now, not to say that Clinton's budget surplus was the only driving factor, but it was one of them, for sure, and one of them that's often overlooked and not even properly understood. So, what I want everybody to take away from this episode is simply this, that our economy, the way it is currently set up, requires a constant influx of new currency. This will remain the case until such time as we either start exporting more than we import, that is, we get rid of our trade deficit and turn it into a trade surplus, or if people start spending more than they're earning, which, again, on the large scale, on the whole, that isn't really a possibility, at least not for very long. Once people have spent down their savings, you can't continue to spend more than you make without going into a bunch of debt, which is when you get what we had in 2008. Our economy requires a constantly increasing supply of money in order just to maintain itself, for the same reason that an old Subaru requires a constant supply of motor oil, because it's always leaking out. Secondly, the only institution in our country, on the planet, that can increase the supply of currency is the U.S. government. It currently does this through the Federal Reserve, but there is no practical, technical reason why this must be so. Thirdly, the best way, seems to me, the most just way to increase the money supply would be through a job guarantee program. That is, making sure that people who want to work, but whom the private economy is not providing jobs for, adequate work for, can be employed doing something that the community has decided is important, and have the federal government fund it. And that way will ensure that there is continual influx of currency into the economy, and it will be being injected at the bottom of the economy, at the bottom of the income spectrum, to people who are pretty much guaranteed to spend all of that. So that's a very effective, efficient way of injecting money into the economy, injecting currency. And of course, if we do end up with a situation where unemployment, because it no longer exists, and an increase in the amount of money in the economy is starting to lead to ruinous inflation that's really a problem, well, we can deal with that problem when we actually have it. We can deal with that through taxing more. We can deal with that through providing incentives for people to save more. That is the way that we should be going about it. We should not be trying to fight a problem that we don't have by making the problems that we do have worse, which is what we're doing now. I hope this has been somewhat informative for you, and I hope that the background noise has not been too distracting. I am sitting in the Rattlesnake Wilderness area outside of the place where I live, and it's a lovely day. The birds are out, and my voice is starting to go because I haven't had a drink of water in about 32 minutes. So thanks for listening, and tune in next week or the week after. We'll have another episode of Economics for the rest of us. Peace.